Welcome to the Teaching You to Fish podcast, financial literacy for the rest of us. My name is Carl Fish, and I'm the host of this podcast. This is episode 7, More on Insurance. In our last episode, we discussed making the most of your employer benefits, including making the best choices around health, dental, and vision insurance through your employer. But a large portion of the insurance you need, you don't, or at least shouldn't, be purchasing through your employer. And this episode will focus on those types of insurance. First, a reminder that in our last episode we talked about the purpose of insurance. That the purpose of insurance really isn't to pay for things, it's to protect against catastrophe, and that you should therefore make your decisions around insurance with that goal in mind. You are still going to need to pay for the things you use. Insurance is there for the hopefully uncommon occurrence of massive expenses, like your house burns down or you have major medical conditions. So, if you make your insurance choices with that mindset, you will most likely choose to increase your deductibles in exchange for lower premiums. That still provides you the security that if something tragic and expensive occurs, it won't bankrupt you, while paying for the services you do use. Because it lowers the amount you pay for premiums, it will also provide you extra cash along the way. But it's really important to set aside that cash to cover the increased out-of-pocket expenses you may have. As always, it's going to be a balancing act. You do not want to choose such a high deductible that it's a problem should something happen and you have to cover it out of savings. But many people end up choosing too low of a deductible out of fear, not realizing that the extra premiums they are paying would have covered much of the difference of that higher deductible. So let's look at some of the common types of insurance you might get on your own, outside of your employer, starting with car insurance. Every state except New Hampshire requires car insurance, so if you own a car, or 2 or 3, you're going to need car insurance. There are 2 main choices you make when purchasing car insurance: collision insurance and comprehensive insurance. Collision insurance is a must because that's the type that not only helps you pay for any repairs you need if you get in an accident, but it pays for any repairs other people need if you are at fault. Comprehensive insurance covers everything else that isn't a result of the collision, such as damage from weather, animals, and theft. As a result, comprehensive insurance is not a must. You may want it, but you don't necessarily need it. For example, if you have an older car, comprehensive insurance is often something you can drop, or at least raise the deductible on, because the value of having coverage becomes less important as your car becomes less valuable. As was mentioned in episode 4, insurance costs are another reason why buying used cars can save you a lot of money, in addition to the savings in upfront costs from buying used. And as your car gets older, you might not feel the need to keep it looking good and can allow more minor cosmetic damages to just ride instead of getting them repaired. And at some point, it will make sense to purchase a new-to-you vehicle instead of repairing your old one. And you can use the savings from having dropped comprehensive coverage along the way to help pay for that new-to-you vehicle. You can choose different deductible amounts for collision and comprehensive, and sometimes you should. Even with collision insurance, you will want to consider having a higher deductible than you currently do. This is again thinking of this in the context of the purpose of insurance, protecting you against catastrophe. While it's certainly not fun if you are in an accident and your car requires several hundred or thousands of dollars of repair, it's also not a catastrophe as long as no one was hurt. As we talked about in episode 5, car repairs are not an emergency. They are an expected expense. You just don't know when to expect them. While hopefully collisions are very rare, even when they do occur, the role of your car insurance is not to pay for everything, but to make sure the expenses don't have a significantly damaging impact on your finances. Several $1,000s is an annoying expense. $50,000 is more of an emergency, which is what the insurance is there for. If you own a home, homeowners insurance is also a must because your home is a significant asset. In general, you only want insurance on assets, not liabilities. Depending on where you live, you also may need supplemental policies specifically for wildfires and floods, as those are often not covered under your regular homeowner's policy. In general, you want homeowners coverage that will cover the replacement cost of your house if something truly horrible happens. But, again, That means you have quite a lot of leeway in deciding how much of a deductible to have. As always, individual circumstances vary, but in general, you should consider raising the deductible on your homeowner's insurance for the same reason you should consider it on your vehicles. The purpose of your homeowner's insurance is to protect against catastrophic loss, not the relatively minor expenses of something like hail damage. Yes, repairing your roof due to hail damage can be expensive, but the yearly savings in premiums can more than make up for the increased deductible costs on the rare, hopefully, occasions that it happens. And insurance will still pay for the amount above the deductible. It's worth taking the time to get quotes from your insurance agent for various levels of deductibles and then doing the math to see which level deductible makes the most sense for you. Life insurance is another type of insurance that you typically purchase on your own. Employers sometimes pay for some life insurance for you, which is great, and then sometimes also offer supplemental life insurance you can choose to pay for. While this varies, in general, it's better to get life insurance on your own than through your employer. The amounts you can get through your employer are often not the amount of life insurance you actually need, and the rates are often higher than you can get on your own. There are certainly exceptions to this, so you need to check. Supplemental employer-based life insurance can be a great option if you have a health condition that disqualifies you from getting life insurance on your own, because employer-based plans often, but not always, are available to you no matter your medical history, which is also why they are often more expensive than getting it on your own. The first question to ask, however, is whether you even need life insurance. In general, if you have people who are dependent on your income, typically kids, sometimes a spouse or dependent elderly parents, you will want to have life insurance to make up for your lost income should you die earlier than expected. If this applies to you, then almost everyone should purchase low-cost term life insurance. Very, very few people should choose other types of life insurance, sometimes referred to as whole life, universal life, or permanent life insurance. These types of policies try to combine life insurance with an investment vehicle, but due to higher fees, they often result in doing both jobs poorly. Get term life insurance for your life insurance and do your investing elsewhere. For most people, you no longer need life insurance once your kids are out of the house, or if you don't have kids. There are certainly exceptions to this, and for some wealthier people especially, life insurance can be useful for tax purposes. But most people don't need life insurance once they no longer have dependents. And you definitely don't need life insurance on your children. In a financial sense, children are liabilities, not assets, and you don't want to insure liabilities. If you do need life insurance, then term life insurance typically means that you will have a fixed premium for the term of the policy, and you would select the term based on how long you need to be covered. That often, but not always, means a 20-year term if you purchase this when your kids are born or when they're still very young, as that gets them to the age where they are independent, or hopefully at least close to being independent, and won't need your income. Keep in mind that you often have a certain amount of life insurance paid for by your employer, and you may even receive a death benefit if you have a pension, so factor those amounts in as well. How much to purchase varies based on your individual circumstances and should be reevaluated periodically. But the goal is to replace a significant portion of your lost income in order to provide for your dependents until they become capable of providing for themselves. If you do the math, significant portion of lost income times number of years until they become independent, that can be a significant amount of coverage that you may need. When you shop for term life insurance, be sure to get quotes from multiple companies. At the time of this recording, PolicyGenius.com or Term4Life.com are great places to get quotes from multiple agencies, in addition to working with your existing insurance agent. One other type of insurance that some people don't think about, and don't want to think about, is long-term care insurance. Unfortunately, medical insurance, including Medicare, does not pay for long-term care, and the majority of folks, current estimates are over 70%, will have at least some long-term care expenses as they age, and some folks will have significant expenses. Long-term care insurance, and long-term care itself, is complicated, but let me touch on some of the basics and then give you a resource to learn more. There are generally 3 levels of long-term care: assisted living, memory care, and nursing home. Assisted living is for when both your body and your brain are still pretty good, But you need some help with what are called activities of daily living. These include things like bathing, getting dressed, toileting, transferring, getting up from a bed or a chair, incontinence care, getting to places, including doctor's appointments, and taking your medications. Note that this doesn't always occur in an assisted living facility. Many folks hire people to come into their home to help with this, and that can be a less expensive option. Memory care is for when you are no longer cognitively capable of taking care of yourself, even if your body itself is in good shape. This is usually due to various forms of dementia, including Alzheimer's, but can also be the result of a stroke. This is a higher and more expensive level of care than assisted living. Nursing homes are for when you need 24/7 access to medical care, which is a level of care that assisted living and memory care typically can't provide. The costs of each level of care can vary greatly, depending on where you live, what amenities and services you want, and the level of care you need. Even within each of those categories, the level of care you need can vary and the price varies with it. To give you a rough idea, at the time of this recording, here are some typical prices in the Denver metro area of Colorado, where I live. Assisted living in a facility is typically going to cost between $6,000 and $10,000 a month. Memory care is typically going to be between $8,000 and $14,000 a month. And nursing homes are typically going to start around $12,000 a month and go up from there. The average amount of time that people need long-term care is around 2 to 3 years, but average is doing a lot of work there. You just don't know how long you might need care. Again, health insurance and Medicare do not pay for these, and those are amounts that many people are going to have trouble affording for very long. The good news is that if you exhaust your assets, Medicaid will indeed pay for long-term care, but that's generally not something you want to happen. First, it means you have to exhaust your assets, and if you have a partner, that means you generally have to exhaust most of their assets as well. Second, any income you do receive from a pension, Social Security, or anything else has to be applied to your long-term care expenses, and then Medicaid only picks up the rest. Third, not all facilities accept Medicaid because of the lower reimbursement amounts, and the facilities that do tend to not be as nice or offer as many services. So what's the alternative? The alternative is long-term care insurance, but there are some important things to know about it. First, not everyone can get it, because unlike health insurance under the Affordable Care Act, long-term care insurance is not guaranteed issuance. You can be denied coverage based on pre-existing conditions and your medical history, and people often are. Second, long-term care insurance is expensive. Premiums are often $500 a month and sometimes much more, and you typically pay those premiums for many, many years before needing care. How many years? Well, the ideal time for most people to purchase long-term care insurance is in their early to mid-50s. Many people are surprised that they should purchase it at such a young age, but here's why. As previously mentioned, there is no guarantee that you will get approved for long-term care insurance. You are often denied based on current medical conditions or your medical history. As you get older, more of those issues start to present themselves. So if you want to get long-term care insurance, it's best to get it earlier before some of those things present and you might get denied. Second, the premiums you pay are very much based on your medical history and your age, and the younger you are, the lower your premiums are likely to be. Unlike term life insurance, premiums for long-term care insurance are not fixed, and they can, and often will, go up in the future. But the key point to understand is that once you have your long-term care insurance policy, any future premium increases cannot be based on your health or your age. Insurance companies can only raise premiums on everyone who has a policy in a given state. They have to raise the premiums for everyone by the same percentage amount, and any increase in the premiums is regulated by law, and a portion of the increase has to come out of the insurance company's profits. So by locking in your initial premiums at a lower level, by purchasing at a younger age, you have locked in a lower base level of premium that will make any future premium increases be smaller for you. And third, while no one likes to think about this, we just don't know at what age we will start needing long-term care. While we all hope that if we need it at all, it will be much later, like in our 80s or 90s, we just don't know. And if you don't have a long-term care policy in place before something happens, You won't be able to get it after something happens. Having said all of this, not everyone should get long-term care insurance. First, obviously, if you don't qualify, you can't get it. But even if you do qualify, it may not make sense for some people to get it. This is a simplification, but in general, there are three categories of people to consider. The first category is people who don't have a lot of assets and/or they don't have enough income to pay the premiums. They either don't have any assets to protect from long-term care costs or they simply can't afford the premiums. For these folks, the best strategy is likely to not purchase long-term care insurance, but instead plan on relying on Medicaid to cover any long-term care needs. While relying on Medicaid is not ideal, it will provide you some level of care. The second category is people who are very wealthy. These people can self-insure because they have enough money to pay those long-term care costs without significantly impacting their overall assets or the lifestyle of their partner if they have one. These folks may still choose to purchase long-term care insurance as a hedge and to protect their assets, but they don't necessarily need it. The third category are the people in the middle. They have a decent amount of assets that they want to protect, and they have the ability to pay the long-term care insurance premiums. These are the folks who definitely want to look carefully at long-term care insurance, again, likely in their 50s. How exactly you determine if you are in the middle category is going to vary based on your individual circumstances and your preferences. But as a very rough ballpark, I would say this applies to people with between $1 million and $8 million in assets. It's complicated, but this at least gets you started. The free ebook, Long-Term Care Insurance Now, is an excellent resource to learn more, and I highly recommend you download and read it. I have no affiliation with the author, nor do I receive any compensation from them. I just found this book really helpful. So consider raising the deductible on your auto and home insurance. Evaluate whether you need life insurance in the first place. If you do, figure out how much you need and then buy low-cost term life insurance that expires about the time your kids become adults. And everyone should at least explore their long-term care insurance options when they are in their early 50s, even if they ultimately decide not to purchase it or can't qualify for it. And try to live your life in a way that decreases the risks that you have a large claim. Drive responsibly, wear your seatbelt, make your house defensible against wildfires, eat right, and exercise. All of those things will not only make your life better, but they make it much more likely you won't have to pay those out-of-pocket expenses to reach your deductible, or that you will need as much long-term care when you're older. If you are taking notes throughout this series, consider writing a paragraph or two, or more, reflection on this exercise, summarizing your current thinking about your insurance choices. If you're comfortable sharing your reflection, there are several ways to do that. If you're watching or listening to this on Spotify or YouTube, then you can leave your thoughts and/or your feedback and questions in the comments. You can also always reach out to me directly on social media or via email. I'm Carl Fish on Blue Sky, Twitter, Facebook, and YouTube, or you can email me directly at carlfish@gmail.com. In our next episode, we'll take on debt. Well, perhaps I should rephrase that. We'll take on the topic of debt.